Good afternoon, everyone, and welcome to this online presentation of our March 2022 Economic and Fiscal Outlook. Thank you for joining us. I'm going to take you through the highlights of our latest forecast, and we'll then go into an online question and answer session. My slides and speaking notes will now be available on the website, where we'll also be posting a recording of this event. If you'd like to ask a question at any point, please use the Q&A feature, and we'll try and answer as many as possible. Let me begin by thanking the staff of the OBR, Treasury, and across government, whose expertise, adaptability, and hard work were once again essential to putting together this latest forecast. Let me also officially welcome David Miles, who joined Andy King and me on the OBR's Budget Responsibility Committee in January, and replaces Charlie Bean as our economy expert. And I should stress that all assumptions, analysis, and conclusions presented in this latest economic and fiscal outlook are our own. This was another EFO prepared against the backdrop of an unfolding shock to the global economy, this time caused by the Russian invasion of Ukraine on the 24th of February. The invasion happened midway through the preparation of our forecast and prompted us to keep it open longer than usual to capture new data, especially on the reaction of world energy prices. Our forecast is based on average oil and gas prices in the 5 working days to the 2nd of March, a week after the start of the invasion. Global energy prices have been highly volatile since then, initially upwards on the back of speculation about the possibility of Western sanctions on Russian exports, and then downwards as the scope of those sanctions became clearer and hopes were raised about the prospects for a ceasefire. And as of this morning, gas and oil prices were fairly close, gas a bit lower, but oil a bit higher, to the levels assumed in our central forecast. But we illustrate in a scenario in the EFO what the economic and fiscal consequences would be were prices to spike up back to close to their pre-invasion peaks. This is also an unusual spring statement for the amount of policy in it, both to mitigate the immediate impact of higher energy costs on households and also to deliver permanent reductions in personal taxes. And I'll talk about their impact on disposable incomes, the tax burden, and the Chancellor's fiscal targets in the second part of my presentation. But let me start with the most important development since we published our last forecast in October. The Russian invasion of Ukraine is first and foremost a human tragedy and a reminder of the terrible costs of wars and the immense and immeasurable losses for those caught up in them. But it's also had serious repercussions for the global economy, whose recovery from the worst of the pandemic was already being buffeted by the Omicron variant, supply bottlenecks, and rising inflation. The UK doesn't have extensive trade links with either Russia or Ukraine, so our economy's most direct exposure to the invasion is via its impact on the global price of energy. And while around 2/3 of our oil and gas imports come from the US, Norway, and Qatar, and less than 10% come directly from Russia, we pay global prices for all of them. And Russia is a major player in global gas and oil markets, accounting for 17% and 12% of global production respectively. So it's mainly via its impact on global prices for gas and oil, and their knock-on effects for UK inflation, that the Russian invasion and international response affects our forecast. But we also take account of the invasion's impact on other important economic and fiscal determinants, including on global GDP growth, which we've reduced by 0.5 percentage point this year, which matters for demand for our exports, on UK equity prices, which have fallen by 2% following the invasion, and which matter for capital gains tax receipts, and on interest rates on UK government debt, which fell back modestly in the wake of the invasion. We did not explicitly take account of price rises in other commodities, such as wheat, nickel, and other raw materials, but we did augment the first effect of higher gas and oil prices on UK inflation by 25% in order to take account of the wider indirect effects of higher energy prices on the cost of and demand for other goods and services in the economy. When looking at the implications of this latest energy price shock for the UK economy today, it's important to bear in mind a number of factors which make us different, both from the UK economy that experienced the oil shocks of the 1970s and from other European economies faced with the same energy price shock today. First, having been a net exporter of energy during the North Sea boom of the 1980s and 90s, the UK has gone back to being a net importer of energy over the past 2 decades, as you can see from the blue line in the chart on the left. This means that rises in global energy prices are, like they were in the 1970s, a terms of trade shock, which reduces our overall living standards. But we've also become a less energy-intensive economy since then. The energy intensity of UK output's fallen by 2/3 since the oil crisis of the 1970s, and by over 40% since the start of this century. And our now largely service-based economy is one of the least energy-intensive in Europe, as you can see from the diamonds in the chart on the right. However, over the same period, we've actually become relatively more dependent on gas and oil to meet our energy needs, as rising renewable production has not been sufficient to offset declining output from coal and nuclear power. And as you can also see from the chart on the right, in 2019, we relied on gas and oil to meet 3/4 of our total energy needs, compared to a European average of less than 60%. Taking these three factors into account, we can expect higher gas and oil prices to have a significant impact on the UK economy, but for this latest energy price shock to be less severe than the inflation and output shocks we experienced during the first and second oil crises of the 1970s. Turning now to developments in energy markets, energy prices had already begun to rise as we finalized our last forecast in October, and spiked upwards toward historic highs following the invasion of Ukraine and subsequent announcements of international sanctions against Russia. Our forecasts for gas and oil prices are based on post-invasion futures curves over the next 3 years, and then held constant in real terms after that. This implies that gas prices remain around £3 per therm until the start of next year, before falling back to £1.20 per therm by the end of the forecast period, around twice the levels assumed in our October forecast. Oil prices are about 40% higher than our October forecast at their peak, touching $100 a barrel this year, before falling back to around $80. A more prolonged war or more severe set of sanctions than currently priced into these futures curves would clearly represent a downside risk to our forecast, while a more rapid resolution of the conflict and easing of sanctions would present an upside risk. And we examine the economic and fiscal implications of gas and oil prices returning closer to their post-invasion peaks of over £5 a therm and $120 a barrel, respectively, in a scenario in Chapter 4 of the EFA. In our central forecast, these higher global energy prices feed into domestic inflation in 4 stages. Directly and immediately, through the impact of higher oil prices on the pump price of petrol and other fuels. Also directly, but with a lag, through the impact of higher gas prices on the off-gem energy price cap, which is reset in April and October every year. Indirectly, via higher prices for goods and services that use energy in their production, and indirectly through their effect on aggregate demand, as higher energy prices hit real incomes. These additional energy-driven price pressures add to existing inflationary pressures from global supply bottlenecks for goods and a tightening domestic labor market here in the UK. Taking all of these factors into account, inflation is now expected to peak at a 40-year high of 8.7% in the fourth quarter of this year, its highest level since the second oil shock of the late 1970s and early 80s. This slide looks in more detail at the contribution of different global and domestic factors to the increase in inflation over the next few years. Inflation remains higher for longer than in our October forecast, reflecting 2 main causes. First, the effect of higher oil and gas prices, which you can see immediately push up the price of fuel, shown in yellow in this chart, and the price of domestic utilities, shown in blue, with a lag of several months. Second, we now expect more of a domestic wage response to the rising cost of living in the context of a tighter labor market, which pushes up the price of non-tradable services, shown in the green bars. Both of these factors continue to push prices up even as pressures from supply bottlenecks in global goods markets, shown in red, begin to fade. Inflation drops back below 2% in late 2023 as energy prices fall sharply, before returning back to target by the end of 2025. Turning to the implications for UK GDP, the shock of the Russian invasion hit an economy that, as you can see from the blue line on the left, had only just returned to its pre-pandemic level of activity at the start of this year, after being buffeted by the Omicron variant in December. With higher inflation expected to weigh on real incomes and consumption, we've cut our forecast for real GDP growth this year by more than 2 percentage points compared to our October forecast, from 6 to 3.8%. Real growth then settles at around 1.75% over the remaining 4 years of the forecast. The level of real GDP by the end of the forecast period remains 2% below our pre-pandemic baseline, reflecting our unchanged assumption that the pandemic reduces the level of potential output by this amount. But we have revised the composition of this 2% scarring assumption, however, to reflect developments since our October forecast, and in particular, a mixture of good and less good news coming out of the labor market. The good news is that unemployment has continued to fall, reaching 3.9% in the 3 months to January, rather than rising to 5.2% as we assumed in October. But wider labor market developments have been less encouraging. In particular, we now expect the number of people participating in the labor market to be about 200,000 people fewer in the medium term than in October, and 400,000 people fewer than we assumed in our pre-pandemic baseline forecast. About half of this can be attributed to a smaller population, due largely to lower net migration during the pandemic. The other half is due to lower labor market participation among the resident population, especially amongst older workers. This lower overall labor supply, coupled with continued strength in labor demand, results in a tighter labor market than we expected in October. And this, combined with growing pressures on the cost of living, means that we also expect stronger nominal earnings growth this year of 5.3%. However, even at this faster rate, earnings don't keep pace with rising inflation over the next 12 months. And once one takes account of all the changes in tax and benefits coming in from April, including the additional support announced in this spring statement, real household disposable incomes per person are set to fall by 2.2% over the next 12 months. And as you can see from this chart, this would be the biggest single financial year fall in living standards since records began 66 years ago, and more than twice the roughly 1% falls in living standards experienced during the oil shocks of the 1970s and early 80s. And without the range of energy rebates and tax cuts announced by the Chancellor in today's spring statement, this fall in living standards would have been half as big again at over 3%. Turning to the fiscal outlook, despite these economic headwinds, the public finances have continued to recover more quickly from the pandemic than we expected, with borrowing in this financial year expected to come in £55 billion below our October forecast. This was primarily the result of tax revenues holding up much better during the pandemic than we anticipated, especially amongst higher rate income taxpayers and financial companies. But spending has been revised down too, despite higher debt interest costs, as investment projects have been hit by supply bottlenecks and local authority spending has fallen short of our forecasts. Borrowing is then slightly higher than our October forecast next year due to higher inflation pushing up the cost of government's index-linked debt, as well as temporary support offered in this spring statement to help cushion its impact on households. But borrowing is again lower over the final 4 years of the forecast, as this temporary support is withdrawn and partly recouped. Looking at what this means for the government stock of liabilities, debt is lower than our October forecast in every year, in both cash terms and as a share of GDP. It now peaks at 96% of GDP this year, before falling back to 83% by the end of the forecast. However, this forecast also includes a glimpse of the risks that are lurking in that stock of debt, which we've highlighted in previous reports. Specifically, both the large proportion of government debt that's indexed to inflation and the shortening of the effective maturity of that debt as a result of quantitative easing has made the government's debt stock much more sensitive to changes in both inflation and interest rates. In this forecast, both are rising much faster than we or the Chancellor expected in October, and drive net interest payments to an all-time high of £83 billion in cash terms in 2022-23, and to their highest level in 27 years as a share of revenue at 7.6% in that year. Since much of this jump is driven by the spike in inflation, pushing up the accrued cost of index-linked debt, the increase in debt interest costs falls away the following year. But interest rates on conventional debt are higher in the medium term too. So even when inflation subsided, interest costs still remain £9 billion higher than we forecast in October, despite the stock of debt being lower in cash terms every year. Looking in more detail at what drives the change in borrowing relative to our previous forecast, this change breaks that difference down into first, differences arising from underlying forecast changes shown here in blue, and second, changes arising from the discretionary policy decisions taken by the Chancellor in this spring statement, and by the government more generally since October, which is shown in other colours. Starting with the blue changes, the first thing you can see is that despite GDP coming in broadly in line with our forecast, there was a significant improvement in the pre-measures fiscal position of around £15 billion in later years of the forecast, thanks to stronger tax receipts outweighing inflation-driven increases in debt interest and welfare costs. This is not true, however, in 2022-23, due to the aforementioned spike in inflation, which doubles interest costs and far outweighs the improvement in receipts in that year. Turning to the policies announced since our last forecast and in this spring statement, the first element is an energy cost package, shown in the green bars, which costs around £12 billion in the coming year. This energy package includes a 5p cut in fuel duty from this evening, whose £2.4 billion cost is, in theory, contained to 1 year by an over-indexation of that duty by RPI plus 5p this time next year. There's also a £200 energy bill discount this October, costing £6 billion, and whose cost is recouped over the next 5 years by a levy on household energy bills, raising £1.2 billion a year. And there's a one-off £150 council tax rebate from this April for the 80% of households in bands A to D, costing £2.9 billion in the coming fiscal year. The second element of the spring statement policy package is a pair of personal tax cuts shown in red, which cost £10 billion a year in the final years of the forecast, and comprise first, an increase in the thresholds above which people start paying national insurance this July, costing around £5 billion a year and saving around 30 million taxpayers an average of £290 a year. And second, a 1p cut in the basic rate of income tax from 20 to 19% from April 2024, costing around £6 billion per year and saving around 30 million taxpayers an average of £170 a year. The third and final element of the policy package is a raft of reforms to student loans, shown in yellow, which were announced last month in response to the Auger review. These measures save nearly £6 billion a year by reducing the overall effective subsidy provided by the state to students for new loans. Taking both forecast and policy changes since October into account, this leaves borrowing £10 billion lower in 2024, the target year for the Chancellor's fiscal rules. Looking in more detail at what these changes announced in the spring statement imply for the overall tax burden, as shown in the chart on the left, the permanent cuts to national insurance and income tax announced today, circled in red, reverse just around a quarter of the personal tax rises the Chancellor announced last year. And they reverse around 1/6 of the total tax rises announced by this Chancellor since he came to office in February of 2020, which are the sum of all the dark green blocks in the shaded area of the same chart. The most significant of these tax rises include the increase in corporation tax from 19 to 25% next April, the 4-year freeze in income tax allowances and thresholds from this April, and the increase in national insurance rates this April and introduction of the new health and social care levy next year. And so, as shown in the chart on the right, the tax burden is still on course to rise from 33 to 36% over the next 5 years, its highest level since the late 1960s. These tax rises do play an important role in enabling the Chancellor to meet his fiscal rules, while paying for a state that's 2% of GDP larger than before the pandemic. And the Chancellor continues to meet both the targets he set himself in October to get debt falling and balance the current budget in 3 years, and even does so 1 year early in 2023-24. And by not spending the entire net windfall in this spring statement compared to October, he's actually added to the headroom against both of these rules in the target year of 2024-25, by 10.3 billion against debt falling, and by 6.5 billion against the current budget. And in our next forecast, the 3-year rolling target date moves on to 2025-26, increasing his room for maneuver by a few billion. Given wider developments since October, however, the Chancellor may well need this additional headroom, because the array of risks to the fiscal outlook are varied and growing. This slide lists just a few of the most important ones, split into those arising from a more challenging geopolitical and macroeconomic context, and those arriving from the sustainability of the government's current policy settings in that more challenging environment. On the contextual side, a key risk stems from the future course of the war in Ukraine. Greater disruption to energy markets as a result of the conflict, a widening of that conflict beyond Ukraine's borders, or further tightening of international sanctions could mean energy prices and inflation remain higher for longer. In a scenario in the EFO, we explore the economic and fiscal implications of gas and oil prices returning to their pre-invasion peaks, which could push inflation close to double digits and add around £7 billion to borrowing from next year onwards. And a more sustained rise in energy prices could do more lasting damage, since, as a net energy importer like the UK, it could weigh on the economy's productive potential, the key driver of medium-term fiscal prospects. Rising COVID cases at home and abroad also remind us that the pandemic is not over. And in another scenario in the EFO, we explore the economic and fiscal impact of the emergence of a vaccine-escaping variant this winter, which would lead to a sharp contraction in output and demands for further fiscal support from households and businesses. On the policy side, the more uncertain and more inflationary environment creates risks in a host of different policy areas. The Chancellor's plan to raise £3.6 billion by reversing today's cut in fuel duty with an RPI plus 5p super indexation next year looks ambitious, given that no Chancellor has been able to raise fuel duty rates at all in the previous 12 years, let alone in a way that raises pump prices by 6% overnight. On the welfare side, lags in the uprating of benefits to rising inflation means that their real value will fall by almost 5% in the coming year, and it will then take up to 18 months to catch up with the rising cost of living. Having them keep pace with inflation this year would cost an extra £12 billion. Higher inflation also erodes the real value of the 3-year budget set in last October's spending review by between £5 and £17 billion, depending on the measure of inflation used, and at a time when many departments are already under pressure to clear pandemic-related backlogs. And rising geopolitical risks are likely to create pressure to increase defense spending above the current NATO minimum of 2% of GDP, with each percentage point costing around £25 billion. And these economic and policy pressures must be managed in the context of the heightened sensitivity of government borrowing costs to higher inflation and interest rates, as illustrated by the doubling of debt interest costs in 2022-23 relative to our October forecast, and the £9 billion a year upward revision thereafter. So in conclusion, thanks in no small part to the Chancellor's success in protecting viable jobs and profitable businesses through the coronavirus pandemic, the economy and public finances have emerged from the last crisis in better shape than we expected. But barely 2 years on from the start of the pandemic, the UK and the world economy face another set of challenges which has not had to confront in more than a generation, that of rising geopolitical tensions, energy prices, and inflation. The Russian invasion of Ukraine has delivered a further shock to a global economy that had only just returned to its pre-pandemic level and was already being buffeted by the Omicron variant, supply bottlenecks, and rising inflation. While the course of the war in Ukraine and international response is highly uncertain, we expect it to knock around 0.5 percentage point off global growth this year. And these events have already driven global energy prices to historic highs, which we expect to push inflation here in the UK up to a 40-year high of almost 9%, and reduce GDP growth from 6 to 4% this year. With inflation outpacing earnings and taxes due to rise from this April, real living standards are set to fall by more than 2% over the next 12 months, their largest financial year fall since records began in the mid-1950s. In its spring statement today, the Chancellor's provided £18 billion in rebates and tax cuts to help households cope with rising living costs this coming year, and £10 billion in personal tax cuts over the medium term. Together, these offset around one third of the overall fall in living standards people would otherwise have faced over the next 12 months, and reverse around 1/6 of the medium-term tax rises this Chancellor's introduced since coming to office. Despite these near-term and medium-term giveaways, the Chancellor slightly increased his headroom against his two fiscal rules to around £30 billion. But the array of global risks and domestic pressures on public finances suggests he may need all of that and possibly more to get him through the next few years. And with that, I'll now ask David and Andy to join me to take your questions. You've got a first question from Anonymous. Can you give your assumptions around around households' use of excess savings? The savings rate falls to a historic low over the coming year. Has the assumption around how much excess savings will be spent changed since October? David, do you want to have a first go at that?
Yes, I don't think it has changed very much. I think we assumed back then that something like 5% of the stock of excess savings would be run down each year. It's no less than that this time round, maybe fractionally higher. I think it does make sense that in a world in which there's been a big hit to incomes, people try and smooth their consumption somewhat. And so I think a low savings rate, and it is a very low household savings rate we expect this year, seems plausible. But we haven't really got there by assuming that people use up pretty much all of the overall excess stock of savings that they have. It's a kind of fairly slow rundown in that stock of savings.
Thanks, David. Second question from Adam Stones. Interest rates have now been low for over 10 years. The rise to 0.75% last week was lauded as an appropriate response to rising inflation, but rates are still extremely low compared to those required to tackle the inflation spikes back in the 1970s. Does the forecast account for the possibility of increases in interest rates, where markets could viciously spiral if rate rises drive defaults? Well, I guess I can say a bit about what we assume in our forecast, and maybe David or Andy might want to say more about the risks to the outlook. I mean, we take in essence the market expectations for bank rates and the yield curve for conventional yields, and so in that sense, our forecasts are based on what markets expect to happen. We do regularly look at the risks around that outlook and the sensitivity of the debt stock to changes in both interest rates, but it's also to point out that our debt stock is also highly sensitive to inflation, something which I pointed out we're likely to see this year as inflation pushes up the cost of index-linked debt. David or Andy, anything that you want to add to that on the risks to the interest rate or inflation outlook?
I think those risks clearly exist, and it's partly, as you say, Richard, because there's more of the stock of debt now, which responds quite quickly to changes in the kind of interest rates that the Bank of England sets, and those that are related to rates that the Bank of England sets. The forward curves, the implied market expectations of what the Bank of England does, is that interest rates can fall back from a peak of close to 2% in a year or so's time. And in some ways that is consistent with our own central forecast for what happens to inflation. But of course, there must be a risk that that doesn't happen, and therefore the bank needs to increase interest rates either by more or keep them at the higher level of close to 2% for longer. And if that were to happen, that would have a material impact on the interest cost of debt to the government.
Okay. Thanks, David. Next question. Can you please elaborate on why you've reduced total borrowing this year by 55 billion, given the latest ONS data, which suggests a 25 billion delta in borrowing against the OBR's October forecast? Andy, do you want to tackle that one?
Yeah, sure. So the data that we're released yesterday, yeah, I saw several estimates of what that might mean, 25 billion or 30 billion, I think were the most common numbers for what that might result in for our forecast. The 25 billion difference between what you would assume taking a run rate from the published data and what we have is largely down to public spending. So the revenue numbers that were published yesterday, the run rate that is implied in our forecast is very similar. There are some areas in central government departmental spending where we have taken the view that departments will underspend their limits by a greater margin than we thought last year. That view is different to what you can see in the data, where the ONS data will be taking numbers that departments have been supplying the Treasury, whereas we are essentially taking a judgment that those will be revised down. There's something quite similar in local authority spending. These are both, particularly in the case of capital spending, which seems to have been hit by the supply bottlenecks. And then there's one last technical issue, which is a downward revision to the expected cost of the loan guarantee schemes that were set up last year that we expect will be recorded in this year's data, but is not yet apparent in the published data. So it's all on the public spending side and things that can't be seen in the data yet.
Okay, thanks, Andy. Next question from Richard Partington. Can you tell me if the 1p cut in income tax is outweighed by measures such as freezing the personal allowance and high rate thresholds? The short answer is yes. There are a number of tax changes coming in from this spring. Some coming in on the 1st of April. Some coming in July. Their net effect on the 2% fall in living standards that we talked about is roughly to reduce that by about a third. But the overall impact of tax and benefit changes, taking account all of the measures that the government announced previously, is to raise taxes in the coming financial year. And of that 2.2% fall in income, about a third of disposable income, about a third of that comes from net tax and benefit changes, taking account not just what the Chancellor announced today on the next threshold, but also the freezing of the income tax personal allowances and the increase in national insurance contributions. So the short answer is yes, those other policy changes outweigh the overall impact on the tax take than what the Chancellor announced today. Okay, next question from Henry Anderson. How difficult is the financial outlook for the health service given the increase in inflation? How does this vary between different measurements? You may not have got to it yet in the EFO, but there is a whole box looking at the pressures on the health service. And traditionally, the health service budget has been a big source of risk to the fiscal outlook for the government, and something which has been in the past regularly topped up compared to the government's multi-year spending plans. Clearly, the government and the health service have inherited this time around considerable pressures and backlogs from the pandemic, and we explored different scenarios for the pace at which those might be resolved over the medium term. I don't know whether, Andy, you wanted to add anything to that on NHS pressures.
Well, just generally on departmental spending, the upward revision to our inflation forecast, depending on which measure you use, and there's quite a big difference between the two commonly used measures, but the pressure overall on departments looks to be somewhere between 5 billion and perhaps as high as 17 billion pounds. And the NHS is about a quarter of that budget.
Thanks, Andy. Next question, nominal pay growth forecast of 5.3% seems optimistic, even in spite of the severity of forecast real pay declines, in part based on falling economic labour market participation, rising inactivity, but is not the norm for a recession. What has been your average overstatement on nominal pay growth in the past? We almost certainly report that number in our forecast evaluation reports. I'm afraid I can't tell you, don't have the number to hand. We have increased our, you're correct in saying that we have increased our forecast for nominal earnings over the medium term. I think it was around 4% in our last forecast. We've raised it up to 5.3. That's still falling well short of inflation, I should say, which is running at around 7% in the coming year. But it does reflect the fact that we are looking at a tighter labour market than we'd expected back in October. Unemployment's gone down rather than up. And also, we think that there's now going to be lower labour market participation than we thought back in October. So you have got a tighter labour market. You've got rising costs of living. That does point to employers needing to raise nominal pay somewhat to retain and recruit employees. It's still being eroded quite significantly by the rising cost of living, which is something which didn't happen as dramatically in the inflation shocks of the past, when nominal wages were more directly indexed to inflation and kept pace with them much more closely. David, anything you wanted to add on earnings growth?
Well, of course, in some sense, our forecast of 5.3 looks a high number, and it is a high number relative to the kind of average wage increases we've seen, well, for most of the last 15 years or so since the financial crisis. On the other hand, relative to inflation, it's a low number, so it's an erosion for most people anyway in the real wage, the real earnings that they'll get. I think it makes sense that this number should be significantly higher than we've seen in the past, even at times like 2011 when inflation was also quite high, precisely because the labour market is very tight. And that wasn't true back in 2011 when inflation got to almost 5.5% at the end of that year, and yet unemployment was probably twice as high as it is today. So I think a high number relative to recent history makes sense, but perhaps not able to match the spike in inflation that we expect this year.
Okay, next question. Without policy changes announced today, the fall in living standards would have been over 3%. However, what proportion of the 2.2% fall in the real incomes forecasted can be attributed to net tax rises on income announced this year? Well, the short answer is, as I mentioned before, is about a third of the fall in living standards in the coming 12 months is a result of net tax and benefit changes, and about 2/3 the result of inflation outpacing the growth in earnings figure, the 5.3 figure that David mentioned just now. The next question from the Times: given the tightness in the labour market, what do you expect wage rise? Why do you expect wage rises will not be enough to match inflation and offset the rising cost of living? Are there particular sectors where you expect them to lag behind? David, anything further you want to add on our nominal wage forecast?
I think it is a tight labour market, but I suspect that many companies are also being hit by the rise in commodity prices in general, oil and gas in particular. Therefore, I think there's a kind of spreading of the burden of what is a hit to the average standard of living of people in the UK, and some of it, significant part of it, is being taken by lower real wages, and there's going to be a bit of a hit to profitability as well. So it's kind of it's a sharing of the burden, if you will. Actually, our forecast implies that the labour share of total income, the labour share of GDP, actually goes up a bit in the near term. So in some sense, slightly more of the burden is on capital income than it is on labour income.
Thanks, David. Holly Williams from PA. What have you factored into your forecast in terms of the sanctions against Russia and their impact? Can you give an idea of the economic cost of the UK of sanctions? Well, as I mentioned at the start, the way in which the Russian invasion of Ukraine and the international response is factored into our forecast is through the impact of higher energy prices. We've also made some smaller adjustments to adjust for changes in energy, changes in equity prices, which were also affected by those announcements, especially for energy companies and those companies that had direct dealings with Russia. But most of the impact comes through higher energy prices. But it's important not to overstate, or it's important to say that we've revised down GDP growth in our forecast from 6 to just below 4. But it's important to say that's the effect of the total rise in energy prices and all the other changes in the global environment that have happened since October. Energy prices were already rising last autumn before the Russians invaded Ukraine. And what that did is basically drive that spike even higher than had already happened by the end of last year. So the world was already seeing a rise in energy prices, basically because there was a big supply-demand mismatch coming out of the pandemic. Lots of demand coming from North America and other places for goods. That demand needing to be met by energy-intensive suppliers in Asia. That was pushing up the price of energy even before the Russian invasion. The Russian invasion added further to the price of energy. We take account of that total rise in energy costs into our forecast. That's what acts as a drag on growth and a drag on living standards in the coming year. It's not all just the Russian invasion of Ukraine. I think what we can say is that we also had to make an adjustment to global growth as a result of the Russian invasion, because basically no international forecaster had produced an estimate of the impact of the Russian invasion on the global economy, and we did knock about 0.5 percentage point off global GDP as a direct result of the Russian invasion of Ukraine and consequences for energy markets. As for its impact on the UK, we basically had to take account of all the events that have happened since October, and those get combined into the impact that you've seen on output and on inflation. A question on any idea about the impact of energy prices on future capital investment or capital disinvestment. David, does anyone want to say more generally about our investment forecast or outlook?
Well, because we use the futures curve for energy prices, you get a very big spike this year, which we're seeing right now. And from about the middle of next year, they really start to fall back quite substantially. So looking at investment incentives further ahead, 2024, 2025, toward the end of the forecast horizon, if prices evolve, energy prices evolve in the way that the futures curves are saying, then you wouldn't expect a very material hit to investment. Of course, I think that story would be different if energy prices pretty much stay where they are right now, and there would be a hit to the rate of return on many kinds of investment, and you would expect that to have a negative impact. I suppose even in that scenario, there'd be a bit of an offset, because there would be some types of technology that would become more efficient to use, more profitable, those which use less energy. And there's a little bit of a potential splurge in investment on those new kinds of technology that become economically efficient. But I think the short answer is, if energy prices fall back in the way that futures curves imply, I wouldn't expect there to be a big negative effect on investment down the road. But all bets are off in some sense if energy prices stay at the very high levels they've reached right now, which is not what the futures curves imply.
Thanks, David. Diana Wallace, have we ever seen a decrease in RHDI, so that's real household disposable income, anywhere near as big as this year's and not had a recession, notwithstanding high stock of savings acting as a buffer? You're right to say that usually when living standards fall, it's because there's been a recession and there's been a hit to real incomes. We have seen on a few occasions falls in household disposable income per capita outside of recessions. There was one back in 2016 when we saw the depreciation in sterling after the referendum, which pushed up inflation, but the economy was still growing. But you're right to say that usually living standards are falling during recessions. And there's both a decline in real incomes and also an inflationary component in what's called stagflation. But I should say, we're not currently forecasting a recession in our forecast. The economy is still growing by almost 4% in the coming year. It's just that inflation is outpacing that rate of economic growth. Anna Isaac from The Independent, how long did the OBR have to factor in changes to the next thresholds into its calculations and calibrate its impact given the £12 billion commitment up to 2024-25? Andy, do you want to have a go at that one?
Well, the process for considering the policy measure itself and for factoring it into the forecast was a normal one. We set out in laborious detail the timetable by which we operate. If by the £12 billion commitment you're referring to how the health and social care levy funds the NHS, we don't look at that specific aspect of the kind of nominal hypothecation. As far as I'm aware, the departmental spending totals have not been changed in this spring statement.
Thanks, Andy. We've got a follow-up on a previous answer, that most of the impact from the war is captured by rising energy prices. Can you speak more about the impact that isn't captured and why not, such as prices of agricultural commodities and metals? I think it's important to note that the most important impact has been through global energy prices. We didn't attempt to capture all of the possible impacts of other commodity prices on our forecast, partly because there's a limit to the number of variables you can actually capture in these kind of forecasts. We did, in order to basically take account of the wider effects of the Russian invasion on other commodities, on the rest of the economy, augment that energy price effect by 25%. So to the extent to which we have captured the impact of the invasion on other commodities like agricultural commodities, like metals, that's included in the sort of the extra 25% hit that we've added to inflation from just energy alone. One of the reasons why we focused on the impact of the energy price changes as the main driver of the impact on the UK economy is the fact that, in essence, it's very hard for the economy to substitute away from the energy sources that it uses right now. You can't suddenly go from putting petrol into your car to plugging it into the wall. You've got the car that you've got. Power stations use the energy sources that they have to generate energy. That's not as true of things like agricultural commodities. People can shift away from using from using some commodities into others. People can substitute the kind of food that they eat, but that's not the case for how we use energy. So rather than trying to estimate the substitutability of all the different commodities that go into the UK economy, we just have this general 25% augmentation to the energy price effect to capture the impact of price rises elsewhere in the economy, including to other commodities. This next question is definitely one for Andy. Can you explain the change in student finances and why you penciled in a gain to the exchequer of £35.2 billion over the forecast if there's no cash gain from the changes now? And why does the annual impact of these changes vary so widely? And that's from Neil McDonald, Channel 4 News. Andy, over to you.
Well, there is a box in the EFO for you, box A1, but the student loan system in a previous vintage of how it was recorded, the loans were all treated as normal loans, even though a very large proportion of them was expected to be written off after 30 years. And so that ultimate cost of the exchequer wasn't recognised anywhere. And so the system was revised so that essentially the proportion of loans that is expected to be repaid are considered loans, and the proportion that is not expected to be repaid is considered as normal public spending that hits the deficit. Those are the numbers that you're referring to. Now, during the period when the costs were not recognised in borrowing, the system essentially got more generous, but those costs were not recognised. Now that they are recognised, any changes are recognised up front, and that's what this does. The student loans reforms reduce the effective subsidy in the loans, so therefore they reduce the amount of public spending that is recorded to recognise those future costs. It's very uneven across years because for existing borrowers, the changes are all recorded at once, so that's the big saving at the start. But then for new borrowers, they are recorded as the loans go out the door. So that's the 5 or 6 billion a year thereafter.
Thanks, Andy. Jack Barnett, City AM, you're forecasting a 0.2% drop in productivity this year, despite a £10.6 billion rise in business investment. How much of a negative impact is poor productivity growth having on shielding household living standards from inflation? Maybe I should say a few things, and David might want to come in on this as well. I mean, one of the reasons why productivity is falling this year is because more people are coming back into the labour market. So to some extent, this is a sort of normalization of productivity growth back to its pre-pandemic levels. And so because more people are coming back into the labour market, average output per worker goes down, basically as the number of workers coming back in is rising. You've got unemployment falling, you've got employment rising, although not as much as we thought, but that's one of the reasons why you see a year-on-year fall in productivity. In the long run, we do have a small hit to productivity as a result of the pandemic, and it returns to about sort of 1.25% growth by the end of the forecast period. The drop this year is, as I said, more to do with the denominator, which is the number of workers, rather than the numerator, which is how productive those workers are at work. David, anything that you wanted to add to that?
Just to say that it's certainly the case that the higher is investment, the higher is the capital stock, and other things equal, would increase productivity, labour productivity. But the 10.6 billion rise in business investment that Jack mentions has got to be taken as a proportion of the capital stock. And that capital stock is many, many times bigger than that, many times bigger than annual GDP. So it's actually quite small as a percentage of the capital stock. So it's not enough to outweigh the forces that Richard was talking about of a recovery in participation in the labour market, which actually brings people back into work and slightly lowers the capital stock per worker.
Okay. Thanks, David. Next question, to what extent are sustained historically low interest rates able to explain equally sustained poor productivity growth, with cheaper credit meaning business and government are less likely to innovate or achieve efficiencies? I suppose that this comes back to whether having low interest rates is a good or bad sign for the health of economies and the health of public finances. It certainly makes it cheaper for governments to borrow, but if they do reflect a more pessimistic outlook about the real growth in the value of other assets in the economy, and therefore the real growth of the economy itself, then it could be less good news for governments. We've looked a lot in the past, including in our last fiscal risks report, about the outlook for both long-run interest rates and also for productivity. Both remain historically low in the UK. I think the challenge in this forecast that we presented is that the interest rate part of that is starting to rise. You've seen interest rates rise since our October forecast. You saw the consequences of that in the near term with a big spike in interest costs in the coming year, and about an extra £9 to £10 billion every year in interest costs over the medium term. That's from rising nominal interest rates. That's not matched for the moment with a pickup in productivity, and so that's one of the things which is starting to put a squeeze on the fiscal outlook over the medium term, notwithstanding the fact that the Chancellor's got a bit more headroom from the fact that he got a big tax windfall this year, and from the forecast we presented over the medium term. It's a question from an anonymous attendee. In an era of increased openness and transparency from the public authorities, will the OBR consider moving towards making the methodology and code open source, enabling greater scrutiny? I suppose it is one of our founding missions to provide maximum transparency about both the economic forecast as well as the fiscal forecast and the process in putting those forecasts together. I can't take very much credit for this because I've only been doing the job for a bit more than a year, but I think all the work that the OBR has done over the last 10 years has added, I think, a great deal to the amount of information and knowledge people have about the economy and public finances on days like this. Where people have specific questions about how we put our forecast together, we do our very best to answer those in as much detail as people are interested in. And we do actually have our forecasting models on the website and regularly update them so that people understand the models that we use. I don't know whether my colleagues, including Andy, who's been doing this longer than I have, would want to add anything to that. But I think we're always open to new ideas for becoming more transparent about the work that we do and more transparent about the state of the public finances.
Yeah, I would echo that if there are requests, that we'd be very pleased to hear them. The economy model is on the website in full. The fiscal forecast is something that's compiled using models that are owned by lots of departments around government. Some of which are very large micro simulation models full of individuals data that the OBR does not see because we don't see taxpayer or benefit confidential data, so that we can't publish the whole lot wholesale. But as Richard said, if there are requests, we're very happy to look at them.
Okay, follow-up question from Jeff Tilley. Do you mind if I come back on this? Is quite a bit of the stronger pay growth down to city bonuses with a peak of in Q2, Q3? Does that mean you're predicting bumper payouts? Andy, do you want to take that one?
Well, it's definitely true that we expect bonus growth to be strong this year. We do publish the numbers, so For this year, we're expecting 20% growth in financial sector bonuses and 31% growth in business services bonuses. The first being a repeat of what was seen last year, and the latter being in line with tax growth from that sector, which has been very strong throughout the year.
Okay, thanks, Andy. Follow-up question from Richard Partington. Have you done any analysis of the fall in RHDIs, that's in living standards, across the income distribution? Is it possible to know if those at the bottom end of the distribution have a bigger decline in disposable income? Apologies, I missed that in the EFO. We don't, as a matter of course, produce distributional analysis. Our excellent colleagues at the Institute for Fiscal Studies and at the Resolution Foundation do, and I'm sure they're working on that as we speak. And I think I'll leave it to them to comment on the distributional impact of the changes we've announced today in our forecast and of government policy. Okay, I think that brings us to the end of the list of questions. Thank you very much indeed to all of you for taking the time to listen to us today. If you have any further questions or indeed any ideas for how we can do these presentations better or improve the format of our forecast or our documentation, we are always open to ideas. You can find contact details on our website, and we'll put them up at the end of this presentation. But thank you once again for your attention. Have a very good afternoon.